Welcome back to our intermediate financial accounting class. This is our discussion of the conceptual framework, and we've talked about a lot of different pieces of the conceptual framework. Our last segment was a little bit long. That's okay. There's a lot of cool information that we wanted to keep together. So far we've talked about the conceptual framework and all of these different pieces that you can see up here around me. We've talked about the objectives, we've talked about the elements, we've talked about the characteristics and the principles and the limitations as far as constraints go. We've talked about where financial reporting fits in and what it provides. We've talked about IFRS and convergence. Now we just have a couple more minutes to kind of wrap up this discussion. So with that said, let me just take a few minutes to talk about the IFRS framework. So the IFRS framework originally was taken from US GAAP, which is a good thing for us. It means that a lot of the basics that they're using as their bridge in their framework are based on ours. So it's helping with this whole convergence process to say that, well, you're pretty close to what we're doing anyway. We can just kind of tweak it. And that's what's happening right now, is the boards are going back and tweaking the conceptual framework, creating one common set of concepts that we're going to use for everybody. What it means for us, though, is that the framework isn't set. It's a moving target. And we have to keep track of that. So familiar things we've based on our decisions on for a long time are going to change. The revenue recognition that we did in the last segment is one of those, because it has just changed. It used to be 3 little quick elements. Now it's that big list of 5 things. It's changing, and people are going to have to change with it. We're hoping, too, that some things, like the unit of account debate, that really we haven't had a good resolution on, hopefully we now will. And that will be a good thing. But let's talk about a couple of the tweaks, things that are changing. One of the big ones is that we're moving away from reliability to the idea of faithful representation. So we're not as concerned with precision of the numbers as we are with somebody else can come in and check and make sure we're doing it the right way. If you remember, we used Old Faithful as our picture of reliability. And basically what we're saying is we're going away from this and going towards the fact that somebody could come into our financial statements and check and I apologize, my pictures are not very good, and that's a magnifying glass, just so you know. If someone were to come in with a magnifying glass, they would be able to check and be able to come up with the same numbers. So that's a change from reliable to this faithful representation. And it's a change that's already happened, and it's tweaking just a little bit the way we're doing things in accounting. The next one is the idea of a matching principle. We're getting rid of matching. We don't want to keep track of matching anymore. Instead, we just want to keep track of things as they happen, as opposed to matching things up specifically. Also, we've gotten rid of the idea of conservatism and replaced it with neutrality, and we had that in our image before. But this was something that we did for a long time. And you remember we talked about the historical cost assumption, where we used in a bill to decide on what we would report in our financial statements, and we're changing that. Again, that's going away. We're replacing it with this idea of what is it worth on the open market. So here's my auctioneer with his gavel. And we're moving away from this historical cost idea and towards the idea that we want to keep track of things at what they're worth now. And there's good and bad here, right? It's good that our assets are going to be better and they're going to match up with reality better, but it's bad because now there's not a specific number. It could be easier for people to play around with. So we'll see what happens with this change in our definition. The last one, some of the definitions have changed. Nothing significant from where we are. Some things on the margin as you get into some of the rules are just a little bit different. All right, and with that wraps up our discussion of the conceptual framework. There's lots of other things we could talk about that could be part of this. I think we're going to leave it there, though. But just be aware, the conceptual framework forms a vital part of what we do in accounting. And as we move forward and talk about now some actual journal entries and other key elements, you're going to come back and see where these concepts and pieces of the framework have been used to create certain rules. And you're going to be able to tell where the political process has come in and changed it, because the rule just doesn't jive. It just doesn't make sense with what we say we want to do. So anyway, with that background, I think we're good to go. Now we're going to move on and talk a little bit about the accounting cycle.